Hey everybody, it's Pete. Welcome. Today is Monday, June 1st, 2020. Welcome to this episode of Stocks for Breakfast. Today we're going to talk about something that is bothering a lot of people, and I think it needs to be put into context. But first of all, thank you so much for the feedback. It's awesome. I love knowing what everybody wants to talk about. I especially am not happy that there's something frustrating a lot of people, but that's the point of these videos, right? Is we can dive in and work on them together as a community. That's the most exciting part to me. If you find these videos helpful, click down, do me a favor and subscribe. That would be awesome. Also, if you have comments or feedbacks or anything you'd like to discuss, that's a big deal too. Leave that in the comments as well. So what we're going to talk about as far as understanding how and when to take profits, it is a big deal because a stop loss is no big deal. You look down, you look at the chart, and assuming you're long, and you're like, it gets down there, I'm out of here. Now, what's interesting is you put the stop loss in a spot. If you're doing it properly, you're putting it down in a spot where here's the thought process behind the way I look at it. You put it in a place that if it gets down to that price level, it invalidates that entry timing. It does not invalidate the idea. So in other words, you put the trade on, if it gets down to that idea, that particular entry did not follow through. So even if it was a good entry, it was not a valid entry as far as the order flow, the buying pressure in this case, just wasn't ready to kick it into gear again. But something that's really important is we often don't take into consideration of, well, how did we come up with that in the first place? And then we don't do the same thing on the other side, which is kind of weird. Like we're just like, okay, I'm going to get in the trade. I know my stop loss. And then the profit target for some reason just becomes like this nebulous thing. I'm supposed to hold the trade until I'm either scared out of it or if you, like I've done at some point in the past, but like, I hope it moves so fast in my favor. But we don't want to do that. We want to have something that is repeatable, something that is a process that allows us to look at every single trade that we're in and know exactly how we plan to manage it. Now, sure, here's where two big scenarios where most of us get messed up. The first one is where we have a previous losing trade, or maybe we're on a losing streak, or whatever it happens to be. Or maybe it's Friday and we haven't really made that much money this week, or it's the end of the month. And you tend to want to book profits just because you have them. So moved in your favor a particular amount, and you're like, oh gosh, I don't want to give back this money, so I have to hold on to it. And I better book it now. As soon as it starts to move up, I better book it. And the problem with that is booking that profit has absolutely nothing to do with the quality of the idea and how much money you could make. And I know that sounds way, way oversimplified, but it's the truth. Our losing trade has absolutely nothing to do with how we should be managing the next position, which actually brings me to another point. I got mosquito bites this week, and they're annoying me like crazy. You wouldn't believe it. Is actually assuming, first of all, that you're in a good trade. That's something that is actually very enlightening in the coaching program that we have, is that one of the biggest things that I hear people requesting, which I completely understand, is can you call out your trades more often? And I call out every trade, just for full disclosure. I call out the idea. I call out the idea before it's happening, which is really good trading because you have to start anticipating your entries. It can't just be like, there's the entry, everybody jump in. There has to be, you have to learn how to build the argument for the trade, and then the exact price to get in, the stop loss, and then ultimately the trade management, which is some of the stuff that we're going to discuss today. But here's my point. My point is, if you're not in an environment where you can call out an idea and have somebody say, that's a great idea, versus what in the world are you looking at? You might be thinking that you're in good ideas and you're mismanaging them, when probably half of them, if not more of them, are not good ideas. And then you beat yourself up for not making enough on those ideas when they weren't good ideas in the first place. So if you're new to the channel, everything I talk about is you need to know, you need to know what your A+ idea is. And then everything away from that has a scale, I guess you would call it a conviction level scale, where you would call it your A+ trade. And those are the ones you would hold a little bit longer. And maybe even have a little bit more share size, assuming that trade, the sector, the market are all doing the same thing. So all of that money is kind of like pulling rope in the same direction. But what we're going to talk about today, and I think I want to start out with the context of this book, which is The Complete Turtle Trader. Now, it just happens to be this book that I'm talking about, but the reason I'm talking about this book is because if you don't know the whole story of the turtles, if you could imagine the movie Trading Places with Eddie Murphy and Dan Aykroyd back in the 80s, where there was basically a bet between two commodity traders. That one was nurture versus we could teach them how to do it. That's essentially the real story. The movie, if you look at history, the movie wasn't based on the book, but it's the same exact story. So a little bit of controversy there about who came what. But Richard Dennis and his partner, I can't think of his partner's name, basically took an ad out in the early 1980s. If I want to say 1983, if I'm not mistaken. And they basically hired commodity traders and they taught them the system. And the ironic part was the entire system was taught to them very, very quickly. And I'll give you what the system was at this point. It was essentially a 20-day breakout or a 55-day breakout. I haven't read the book in a long time, but that's essentially, it might be a little bit different, but that's essentially what it was. Now, the interesting thing was they were trading trends. They were trading bigger moves. So they were taught from day one, your profit taking is when that same signal happens in the opposite direction. So in other words, a 20-period breakdown or a 55-period breakdown. So they were holding much longer moves. But what does that imply? That implies before every single trade, they knew exactly how they were going to manage their profits long before it happened. And number two, which is infinitely more important, and I'll get into somebody that I traded with a few years ago that really kind of drills this profit home. His name was Mark. A brilliant trader. They knew exactly how they were managing it. So they were what you would call position traders. Here's the big thing. They were fully okay, and I'm just going to use round numbers here. They were fully okay with a $50,000 or more profit, pulling all the way back to, let's say, a $5,000 profit or a small break even, let's say, in exchange for that security, that commodity in this case, never pulling back and seeing astronomical gains for the 2 or 3 times that it did explode and continue to go in that direction. By the way, if you read the book or if you know the story, and I'm not 100% on those, definitely let me know, but that's the general context. I'm pretty sure I'm right. So anyway, my point is they knew going in that they were going to hold these trades longer. They were not going to watch every uptick and downtick, and they were doing it on daily charts, so they weren't watching every single close. They were only looking for closes that matched their criteria. So you have to ask yourself, but I actually have a little PowerPoint presentation. You have to ask yourself what type of trader you are heading into the trade. And something else that I want to get across very clearly is that, especially if you're day trading, you never want to be exiting. You never want to be managing your winning trades on the same time frame that you entered them on. You will be shaken out of your trades. That I can virtually guarantee, because one 5-minute candle or one 15-minute candle, when you planned on holding the trade for the entire day and there was no reason to get out of it, which we've seen a lot of trades that we've called out in the room, especially in April and May on the move to the upside. It was very prevalent for some of the newer traders to be shaken out of the trades and either not have a system or the plan to get back in. They're very common for a trader to do all the hard work, follow the order flow, have a losing trade, and then go look for something else, as opposed to immediately setting an alert and getting right back in if and when that stock played itself out. We've seen a lot of that, especially in the morning and early in the week for swing trades, where something would trigger, pull back, come close to a stop loss, or maybe even stop you out, go sideways a little bit, and then give you the same exact signal a little bit later, and then have that really big move that you expected in the first place. So that's a big lesson for everybody to learn, is don't give up on a good stock that you did the hard work on. Have alert set, cycle, we call it work the keyboard in the community. Work the keyboard, work the keyboard. Don't just stare at your watch list. Don't have 20 charts and 6 monitors of all these 5-minute charts. You're losing the big picture if you're only looking at one time frame. So it's super important to get across and look at all of those time frames. So what we're going to do now is we're just going to go over to the chart. So again, the single biggest thing about this video that you must absolutely take home is what type of trader are you? So that the Turtle book and the total story, which is a fascinating story and a true story, by the way. Remember, the biggest problem that the newer traders had was giving back paper profits in exchange for the bigger profits. Now, if I asked, now here's the ironic part. If I asked you prior to you beginning a week or a month or a year or something like that, and let's just use a week as an example, whether you're a day trader or swing trader, so it kind of brings it home. If I said to you at the beginning of the week, you're going to make $7,500 this week, but all of it's going to happen on 2 trades. All of the other trades, they're going to wash each other. You're going to make 10 trades, but most of that 7,500 is going to come from 80% of the 7,500. So we'll do 80-20. 80% of the 7,500 is going to come from 2 trades. Who in their right mind is going to say, no, that's okay. I need all of my trades to make the same amount of money? Nobody would say that. But for some reason, when we get into the trades and we're allowing them to play itself out, we tend to like, oh, move to my favor, or I got to get out, or I got to lighten it up, or you need to know what kind of trader you are. And even as a day trader, are you a position trader as a day trader, or are you a momentum trader as a swing trader? Are you a day trader in that position only? Or are you a swing trader? Are you a day trader building swing trading positions, which, by the way, is infinitely easier to do? So we're going to get into, we're going to take a look at this quick. I have a little PowerPoint presentation. And these are all in the context of booking trades. So day trading versus swing trading, a monster consideration. Do you understand? Are you looking to just hold that position and get out into the next 6 candlesticks? Are you looking to hold to the close, which is a much more laid back and in the long run profitable scenario? And I'll get feedback that says, no, I can't, because every once in a while the stock pulls back and I would have given back those profits. Yeah, you're absolutely right. Every once in a while that does happen, but you only need 2 or 3 of those big green or big red candlesticks for the week to make 6 figures. So you have to really ask yourself, am I happy with the wiggles and jiggles and driving myself crazy on every single candle and oh my gosh, the 5-minute candle turned around. And I guess you need to know going into it. And this is what coaching is about. So we can have these discussions, and we're kind of having like quasi coaching through these YouTube videos. And again, leave feedback or comments if you have some questions about this. So you need to know going in, are you day trading versus swing trading? Because if you're swing trading, especially, it's much easier, and I'll pull up the chart there. It's much easier to look at a chart, and this is ironically perfectly laid out for us here in Twitter, where you could look to the left and say each momentum move, how far did that stock move? And that will give you your swing trading target, right? Now, here's the thing. Remember, you put your stop loss in there. What is my profit target? You need to know that as much as possible, and you can't be scared out of your profit target, because 1 out of 5 or 3 out of 10, it's going to follow through. You can't worry about those other ones that pulled back in exchange for the one that followed through and gave you $3,000. And again, I'm just using numbers. So you get 4 trades or 5 trades, let's say, 5 trades where 3 of them do nothing. They break even, small profit, small loss, and 2 of them do exactly what you thought, and you can see how they play out here. So again, you need to know swing trading versus day trading. Much easier to manage swing trade, to project swing trade profits. Day trading is a little bit earlier, and one of the ways that we're going to discuss in a minute. So another thing is momentum trader versus swing trader. Remember what position trader. Remember what I just said about the turtles. The turtles were position traders. Their long-term gains and long-term exit signals were the same as their entry signals. So that's something for you to consider. If you're trading a new 5-day breakout, for argument's sake, you would stay in the trade on a 5-minute candlestick. If you happen to be a day trader, the same signal would be on the other side, assuming the price moved in your favor in the first place. So momentum trader means you're typically looking for a certain amount of candles in your favor, and you're done, and you're looking for the next trade. So you're exiting on a pause. Position trader is not. Position trader is a longer term bias, which may be a longer term moving average, maybe a higher time frame momentum type move as well. But you need to know this prior to going into the trade. And as I get older, I'm leaning a lot more towards position trading, and I'm going to show you in a second how I do that. I'm not as frenetic and active and crazy trading like I was 15 years ago when I was super active and had my trading firm. All right, so next we are going to talk about using two moving averages. This is by far the simplest way to manage profitable trades, as well as the less stressful way of managing winning trades. And I'm going to show you how on this right here. So we'll pull this up. And PayPal on, excuse me, PayPal on Friday is very interesting. If you don't know the daily chart of PayPal, we've been watching it for a long time, and you can actually see why here. But first, I want to go back to the 5-minute chart. So generally speaking, what I'm doing is I'm looking to hold my positions as long as they're above what I would consider the trend on that time frame using the moving averages. So in this case here, the longer term trend for me is the 20-period moving average. And by the way, they're only the simple period moving average. So in this case here, the strategy is the price action has to close on the other side, which will always be faster than the other moving average for exiting the first piece. Then the moving average has to cross the other side to exit the second piece. So the best case scenario that I can give you is, let's say we entered the trade here and it broke out. At no point here during the 5-minute chart did either the price action, meaning the candlesticks, or the moving average cross what we're calling the trend line until over here. So you can see that we had a pretty decent pullback. Right here is the first time PayPal on the 5-minute candle closed below. So that would have been an exit in this scenario, in this instance, to exit half of your position. But you can see that the faster moving average never crossed. So you would have actually held at least half of it the entire time. Now, the other way to do that is to jump to the higher time frame, and you can see it actually never crossed, and you would have held the position all day. So again, that's the difference between position trading and momentum trading. You might call position trading on a little bit of a higher time frame. So that's a very easy way to do it as well. And by the way, that is my preferred method because there's a lot less stress. Next, we have average true range, which is the daily price action from high to low over the last 14 days. So again, we've discussed it a lot. If you're looking at a stock and the average true range is typically $3, and you know the low of today is 10, I'm just going to use an example, $10, $13 is where that stock would normally trade up to on a day where it trades what it normally does. Now, a mistake that traders make is you need to understand what is the overall volatility in the market. What is the market doing that day? Can I reasonably expect the stock to trade more or less than what it's an average true range? What's the sector doing? Is the market on fire today, or are we kind of trading back and forth and this happens to be the only stock? So you need to put all of those things into consideration. But this is a really solid one, and I love this one, especially from a day trading perspective, because you absolutely know this is the number of what it normally does. So you can put these projections out there. But here's the key. If it hits that price, like we've seen in Penn, we've been trading Penn a lot recently over the last 3 or 4 weeks. That doesn't mean to bail on the position. That means to move up a trailing stop. If the stock is on fire, let it go, but move up, put in a trailing stop, and keep trailing it higher as the stock moves higher. And last but not least, higher time frame candlesticks, generally speaking. So I'll show you exactly what that means. So let me go back to the other, let me go here, and I'm going to just show you what this one is. So we're going to go to the 5-minute chart. And let's just say, for argument's sake, we're going to go right back into PayPal again. So if your entry signals are on the 5-minute chart of PayPal, and you are looking to, I'm just using PayPal as an example, and you're looking to hold your trades longer, your signals, and this is what's interesting, is then you go back to the next higher time frame and you look for momentum in that stock, and you determine whether or not it's a momentum pause or if it's a reversal. If it's a pause, such as an inside candlestick or one candlestick, you hang on to the trade. You can also do something super simple like drawing trend lines and understanding when that trend changed, and kind of ironically the same place where it reversed there, or simply hang on to the thing to the close if you see no reason to get out of the position. So I wanted to throw out some ideas for profit taking, because if you're a hardworking, smart trader who has no problem finding ideas, no problem with the entry, no problem with the stop loss, this is kind of the missing link to ultimately getting into and holding those trades. But really think about the mindset part of it, because you need to know prior to the trade, what type of trader am I from a day trading and or swing trading or longer term position trading? And remember that quote that I had said. I had asked my friend Mark, what happens. Mark was a multi-million-dollar trader, and he still is. I said, what happens if a trade pulls back on you, and you go from plus 3,000 to, let's say break even on the position? He said, I don't care. He said, I only need one of these trades to follow through for me to make $25,000 over a couple of days. And if you really think about that, you have to stop beating yourself up over some trades that pull back and focus on the trades that you nailed, and ask yourself why you didn't hold them longer. And hopefully today I gave you some ideas on how to do that. So I hope this video helps. Definitely pause it. Definitely leave feedback. And absolutely, if you like these videos, give me a subscribe and a thumbs up. That would mean the world to me. And you also get updates too. So have a great day, everybody. Hope this video helps you.